One of the most basic elements of economics is understanding supply and demand. Supply is the amount of a good available to a market, whereas demand is the amount of a good needed by the market. When demand equals supply, then you have a market equilibrium and prices are competitive. Going a little bit beyond the basics, you also have supply side economics, where economists want little to no government interaction and encourage less regulation and oversight. Then there's demand side economics, where government regulation and intervention is encouraged to help support and control markets and market outcomes. Most politicians support a demand side economic outlook because it gives them the oversight. In economics, utility refers to the benefit you get out of a good or service. So goods and services that work out well for you or provide you with value are really providing you with utility. Whether you understand utility or not, most rational consumers want to maximize utility to get the most for their money. And if you think about it, if you don't need something to last a long time, you're willing to spend less on it. But also, by spending less on it, you won't expect it to last long or to have much utility. Now, in the same respect, corporations will also want to maximize utility, and they can do this through investments and automation or by optimizing other areas of their business like their supply chain. No matter what part of the economy you're participating in, there's a natural drive to always maximize your utility. And keep in mind, this also means that corporations and governments are going to always find that price point where they can get the most out of you for the product or service offering. And if something gets to the point of being too expensive, the way you let a corporation know is by not purchasing that good or service. As sales decline, they'll adjust their pricing to recapture those lost sales. And if you still maintain your purchases, then you're signaling to the market and to that corporation that that level of pricing is acceptable for the level of utility being provided. Another consideration is classical versus Keynesian economics. And I don't want to get too into the different theories, but the basic difference is that Keynesian economists believe that it's the government's and the economist's job to intervene in the economy in order to try to encourage or curtail certain outcomes. This differs from the classical economists because they want to leave the market alone and let the market or the invisible hand do its thing. Getting a little bit more into the invisible hand of the market, essentially what it implies is that a market will self-regulate, which is an interesting concept, and you might not agree with that. Some people might want to know, what does it even mean to self-regulate? Basically, what they're implying is that if you make a bad product, the consumers are going to figure that out and they're going to stop buying them. And if no one buys your products, you won't have sales and you'll be forced to go out of business. So that's sort of the invisible hand of the market. It can be a good thing or it can be a bad thing depending on what's going on in the market. What I like about what it's implying is that it's saying consumers make rational decisions and provide competitive markets through freedom of choice, which is what we're hoping to help you unlock when it comes to stock investing, more freedom of choice. There are a lot of different ways that you can leverage these concepts. Another way you could view the invisible hand from is that each and every one of you are out there doing what you think is best and pushing for the changes that you think are necessary. And it's only by pushing for change that you're actually going to begin to see it. And you can use your investments to have a voice. Certainly, as a shareholder, you paid for your seat at the table, so don't forget to use it. Another aspect of economics that we don't hear a lot about anymore is antitrust economics. For those of you that are a little bit older, you might remember some of the Microsoft cases or even the Standard Oil case, which we're going to cover more here in a moment. Antitrust economics apply when a corporation becomes too large and controls too much of their industry or a particular sector of the economy. It's not good for consumers because they could now be receiving a product with lower quality and unfair pricing, where if there was a more free market, then consumers would have other choices and the industry would be pushed to advance and be more competitive. That reduced choice and consolidated control can create anti-competitive environments that can also lead to increased barriers to entry. So if you're a smaller firm trying to enter a market, antitrust actions would make it easier for you to participate. But anymore, we don't see too much activity in this area, and in general, large firms are being viewed differently today with policies like too big to fail. Now, that said, while you might be in favor of more government control over markets, you also have to understand that old saying, the road to hell is paved with good intentions. You might think that you're doing a good thing by trying to break apart a massive corporation, giving smaller companies a chance, but ultimately what you might end up doing is creating bigger problems because you got an outcome other than what you expected. And one of the best examples of this involves the story of Standard Oil and John D. Rockefeller. John started Standard Oil as a very ambitious young man and worked really hard to grow his company. He lived a fairly simple life and reinvested a lot of his profits right back into his company, especially in the early ages. That way he could grow as quickly as possible. So he continued down this path, and over time he was able to purchase a large number of oil refineries and continue to expand his holdings. He's even credited with helping to create gasoline itself. It was previously a byproduct from the oil refining process, and it was just being dumped into rivers and lakes. Of course, timing had a lot to do with his success. He already had a ton of control over oil production by the advent of the automobile, and as gasoline supply became a hot commodity, and that allowed for large amounts of capital to flow into Rockefeller's business. Eventually, he exerted a huge amount of control over the oil industry and even had leverage over the US government. So due to some concerns by the government and due to industry complaints surrounding the pricing, distribution, and control of oil, the government stood up to Standard Oil in an effort to break up the company. And after some messy trials and some political theatrics, ultimately the government did win the case and John was forced to break apart his company. Now, what they didn't consider was that John was still the majority shareholder in all of the new companies. And at least from a monetary perspective, he ended up making significantly more by owning all the different corporations than he ever did by just simply owning Standard Oil. And while his wealth only grew, you could debate whether or not he still had as much control. All the new companies had boards, and all of the boards are elected to run the companies. Ultimately, his power as the main shareholder meant he could elect the boards too, but it probably was a lot more of an effort on his part to try and manage it all. And that just goes to show you that you might have good intentions, but that doesn't necessarily mean that you're going to get the right outcome. Antitrust economics are something that I've always been excited about and thought that it should be leveraged, but the problem is that it's not, and a lot of times when it is, it's not really leveraged in the right ways to end up with results that are actually beneficial. So over time, while I'm for the process, I've actually grown to be against too much government control and interaction, and I prefer to let the invisible hand work it out and determine the right outcome. Now, taking all of this in, you might start to wonder what type of politics all these methods support. Well, when it comes to economics, I think it actually simplifies political views. You might be surprised, though, that your economic views do not always align with your political ones. So don't be surprised if this slide challenges who you think you want to vote for the next time you're standing at the ballot box. In order to understand political and economic views, I'm going to show you something called the Nolan chart. And according to Wikipedia, the Nolan chart is a political spectrum diagram created by American libertarian activist David Nolan in 1969. This charts political views along two axes representing economic freedom and personal freedom. You can see the four quadrants here: conservative, progressive, libertarian, and authoritarian or fascist. And depending on how you feel about personal and economic freedoms, you might find that you don't fall on this chart where you were expecting. Now you might be wondering where I fall on this chart since I'm the one coaching you through all of this. And personally, I grew up in a fairly conservative environment, but became much more progressive when I went to undergrad and grad school. And when I first saw this chart, I was in grad school, and it was then that I realized I was much more of a libertarian than anything else. So here is where I believe I sit on the chart. I think I've always been on this centrist libertarian line here, but I've certainly moved back and forth between the conservative and the progressive spectrums. Ever since understanding where I fall, I've always seen that left versus right argument from a different perspective, and it's mostly made me feel like I don't belong to either party. And I don't want a large government or lots of government control, and right now there's not really a large party that represents those views. The reality, though, is that while you may not share my views, I think a lot of people right now do feel like they don't have a political party that represents them, and I hope that changes. Now, this might be controversial, but if I were to put a dot for where I feel the US government is today, I think they'd be here. Now, this is not a negative or anything, it's just my opinion, and my evidence is just that the government is large, their control is widespread, and currently their views lean to the progressive side. Of course, that could change depending on which way elections go, but as I record this, I believe we're here. One additional point that I think is interesting, there's a lot of negativity about fascists, and I just think it's interesting that fascists can lean left or right. I feel like sometimes people try to link them to party extremes within the left or the right, but in reality, like libertarians, they're their own group. Also, keep in mind that this chart was created in the 60s, and it doesn't necessarily represent all of the political and economic views. I just offer it as something to help you think about politics from an economic perspective. I don't have any agenda here. You're welcome to your beliefs, and how you vote is your right, and I'm not trying to influence that. I've brought this up a few times already, but it deserves to be covered again. Capitalism certainly is not perfect, but it's responsible for creating a substantial amount of wealth for people that would not otherwise have access to it, and it's brought considerable benefits and freedoms to the world. One of the best parts about the system is that your money becomes your voice, and your purchases reflect your preferences rather than just necessity. Now that leads to more variety and more freedom of choice for consumers. That helps to create competitive markets, and in competitive markets, the price you're paying for your goods generally reflects the market equilibrium price that we discussed a few moments ago. And in a healthy market, if you don't like something, you don't have to support it. All you do is use your money to support the products and services that you want to see and avoid the ones that you don't want to support. Now, if people choose to use their money to support those products, then there's still a market for it, but you don't have to participate in it, which is okay. You can't control what other people do, and we all have to compromise sometimes. So spend your money on the products and services that you want, and that will help to produce the economy that you want to see. Now, in terms of measuring economies, there are a lot of different economic indicators out there that you can refer to. They can help you measure outputs and forecast how a market is going to perform. You can look at gross domestic product. You can take a look at the central bank interest rates. There are a lot of different currencies out there and debt associated with the governments behind those currencies, so that's something worth paying attention to. A lot of areas around the world will maintain a consumer price index, and understanding the affordability of goods will help you predict economic outcomes. As well, different infrastructure investments should be paid attention to, and understanding a nation's ability to follow through on those things. There are a lot of wonderful ideas being shared today, and while some of them are really cool, you also have to make sure that it's more than just an announcement and that the nation has the ability to follow through on their investment. Then you want to look at things like income per capita and how that's growing over time. You'll want to take a look at worker education levels, and you may be surprised at what areas of the world have a workforce that's more oriented towards direct labor versus skilled trades, or maybe even having a more services-based economy. But by understanding different worker education levels that are already available in different areas of the world, that can help you understand why a corporation might expand in a certain area of the world and make different types of investments in different nations. Now, consumer confidence is another great indicator, as well as the unemployment rate. Unemployment rates can change quickly, but in some areas of the world, they can be pretty consistent. It's worth taking a look at, and of course, everybody wants it to improve, but sometimes it's more of a cultural thing than an economic indicator. You'll also want to monitor birth rates of different nations. Birth rates have always been indicative of economic growth, and the vast majority of growth over the 20th and 21st centuries happened after we've seen large increases in birth rates. Now, from the same perspective, negative or flat birth rates might actually be indicative of slowing or stagnant growth. Ultimately, you just want to have an awareness to all of these different economic measures, and if you're trying to figure out what's going to happen next, chances are looking at some of these will help you figure that out.